This is Thursday, February 26th, 2026. And in the last 72 hours, something happened in the silver market that I have not seen in over a decade of covering precious metals. The spot price of silver just touched $91.40 per troy ounce, a number that would have seemed impossible to most people just 18 months ago. And at the exact same time that price was printing on screens around the world, the COMEX registered silver vaults fell below 88 million ounces for the first time since 2020. Let me say that number one more time. 88 million ounces. That is a drawdown of over 34% in registered silver in less than 14 months. Over $2.1 billion worth of physical silver has left COMEX vaults, and it is not coming back. If you are watching this right now and you are confused, if you are sitting there thinking, the price is rising, so everything must be fine, I need you to stop, take a breath, and watch this entire video. Because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. And if you do not understand what is actually happening beneath the surface of this market right now, you are going to make the wrong decision at exactly the wrong time. Here is what the data shows. Silver lease rates on the London Bullion Market Association spiked to 4.7% annualized this week. That is a number that historically only appears when the physical market is under severe stress. The U.S. Mint reported a 61% surge in American Silver Eagle sales in January 2026 compared to January 2025. The Perth Mint in Australia issued a formal delivery delay notice, something they have done only 3 times in the last 15 years. Premiums on 1-ounce silver rounds at major dealers jumped to between 18% and 23% above spot in the last week alone. And yet the paper price, according to the futures market, is being called orderly. Does that make sense to you? Does that sound like a real, functioning, transparent market to you? The price is rising, but you still cannot get the physical product on time. Let me say that again so it sinks in. The price is at $91, and you still cannot get physical silver delivered in under 3 to 4 weeks from most major dealers. In a normal market, when prices rise, supply increases to meet demand. That is economics 101. That is how every functioning commodity market in history has worked. What is happening right now is the opposite. Supply is tightening as price rises. Delivery times are stretching. Vault inventories are collapsing. Something is very wrong. And by the end of this video, you will understand exactly what it is. My name is not important. What is important is the analysis. If this is your first time here, consider subscribing because this is the kind of analysis you will not find anywhere else. We do not do hope. We do not do hype. We do data. And today, the data is screaming. A few days ago, I made a video. In that video, I told you that the silver to gold ratio was approaching a critical compression zone near 78:1, and that historically, every time that ratio compressed below 80, silver experienced an explosive catch-up move. I told you that institutional accumulation patterns in the options market suggested a near-term price target of $88 to $94. And I told you that the COMEX registered inventory had broken a critical floor and that the next leg down in inventory would accelerate price discovery in ways the paper market was not prepared for. That call was right. Silver broke $91 this week. But here is what I did not expect. I did not expect the Perth Mint to issue a formal delay notice at the same time New York vaults were draining. I did not expect Shanghai Futures Exchange silver inventories to simultaneously drop by 19% in a single week. I did not expect 3 separate major bullion dealers in the United Kingdom to quietly raise their minimum order thresholds from 1 ounce to 10 ounces, effectively locking out small retail buyers. And I did not expect the Bank of England's published silver lending data to show a 28% reduction in available lending stock in the month of January alone. All 4 of those things happened at the same time, and that is what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them money right now. There are essentially 2 silver markets operating simultaneously. They share a price, they share a ticker, but they are nothing alike. The first market is the paper market, the COMEX Futures Exchange in New York, the LBMA forward market in London. This is where the price of silver is set every single day. Trillions of dollars worth of silver changes hands in this market every year. And the vast majority of those contracts, we are talking about more than 95%, are never settled in physical metal. They are cash settled. They are rolled. They are closed before delivery ever happens. This market sets the price of a commodity that most of its participants never intend to actually hold. The second market is the physical market, the actual bars, the actual coins, the actual industrial delivery contracts, the silver that goes into solar panels, into electronics, into medical devices, into military applications. This market is real. It is finite. It is governed by the laws of physics. You cannot print a silver bar. You cannot roll a silver bar forward and pretend it still exists. It either exists in a vault or it does not. Here's what you need to understand. These two markets have been able to coexist peacefully for decades because there was always enough physical silver available to satisfy the small percentage of paper contracts that actually demanded delivery. But what happens when that physical cushion starts to disappear? What happens when the vaults drain faster than they can be refilled? The paper market is like a giant poker game where everyone at the table has written IOUs to each other, and for years nobody asked for the cash. But right now, some very large players are asking for the cash, and the cash is not there. Let me show you the evidence. And I want you to pay very close attention to each of these data points individually, because taken alone, each one might seem explainable. But when you see them together, the picture becomes impossible to ignore. The COMEX registered silver inventory. Let us start here because this is the foundation of everything. As of February 25th, 2026, registered silver, that is the metal that is actually available and committed for delivery against futures contracts, stood at 88.2 million troy ounces. 12 months ago, that number was 134.7 million ounces. That is a decline of 34.5% in registered silver in 12 months. To put that in perspective, the entire registered inventory of COMEX silver could supply global industrial demand for approximately 47 days. That is not a buffer. That is a countdown clock. Let that sink in. Perth Mint, Australia. One of the largest and most respected sovereign mints in the world. In the third week of February 2026, Perth Mint published a notice on their website stating that delivery timelines for silver products had been extended to between 28 and 42 business days due to, and this is a direct quote from their notice, extraordinary demand conditions and upstream supply chain constraints affecting refined silver availability. 28 to 42 business days, that is 6 to 9 weeks to get silver from one of the world's premier mints. Let that sink in. But it gets worse. The Royal Canadian Mint, Canada, one of North America's primary silver processing facilities. Premiums on RCM silver maple leaf coins surged to 21.4% above spot as of this week. Dealers in the United States who carry RCM products reported that their last allocation sold out in under 4 hours. 4 hours. At $91 spot, you are paying over $110 per ounce for a coin that carries the Canadian government's guarantee, and people are still buying it. That is not speculative mania. That is people who understand what is happening trying to get their hands on real metal before it becomes unavailable at any price. The Shanghai Futures Exchange. This is important because the Western financial media almost never talks about Chinese physical silver flows, and that omission is not accidental. SHFE silver registered warehouse stocks declined by 19.3% in the single week ending February 21st, 2026. That was 847 metric tons removed from registered Chinese silver inventories in 5 trading days. Chinese industrial buyers, solar manufacturers, electronics producers, semiconductor fabs, are pulling silver out of exchange warehouses at a pace that suggests they do not trust future availability. They are hoarding. And when Chinese industrial buyers start hoarding a commodity, that is one of the most reliable early warning signals in the commodity world. Let that sink in. The London Bullion Market Association lease rate. This is perhaps the most technical, but also the most telling piece of evidence. Silver lease rates reflect the cost of borrowing physical silver for short-term delivery. When lease rates are low, historically between 0.1% and 0.5% annualized, physical silver is abundant and readily loanable. When lease rates spike, it means someone desperately needs to borrow physical metal, and the lenders are either running out of metal or demanding a premium for the risk. As of February 24th, 2026, the LBMA one-month silver lease rate hit 4.7% annualized. The last time lease rates were this high was March 2020 during the COVID market seizure. But here's the critical difference. In March 2020, it was a temporary liquidity panic. What we are seeing today is a structural drain. That is a panic signal, but it is not a short-term panic. It is the market telling you something fundamental has changed. Johnson Matthey, the world's largest silver refiner and processor, published its 2025 supply-demand analysis in January 2026. The report showed a physical silver deficit of 182 million ounces for the full year 2025. That was the fourth consecutive year of a structural physical deficit. Over those 4 years, cumulative above-ground investable silver stocks declined by an estimated 612 million ounces. To put that in context, total annual global silver mine supply is approximately 820 to 840 million ounces. The market has consumed the equivalent of nearly an entire year's worth of mine supply just from above-ground stocks in 4 years. And mine supply is not growing. Global silver mine production fell by 2.1% in 2025, according to the Silver Institute. Let that sink in. The U.S. Mint data. January 2026 American Silver Eagle sales came in at 6.4 million ounces. That was a 61.2% increase compared to January 2025. It was also the second highest January sales figure in the history of the American Silver Eagle program, which dates back to 1986. The U.S. Mint has been operating under what they call allocation protocols for Silver Eagles since September 2025, meaning they cannot produce coins fast enough to meet open market demand and are rationing supply to authorize purchasers. The world's reserve currency country cannot keep up with demand for its own silver coin. Does that make sense to you? Now let me tell you who is doing the buying. This is perhaps the most important part of this entire video, because when you look at the flow of physical silver on a geographic basis over the last 18 months, a pattern emerges that is so clear and so consistent that it cannot be explained by random market forces. Let me show you the pattern. American financial institutions, specifically the large bullion banks that act as COMEX market makers, have been net short silver futures to a combined tune of over 340 million paper ounces as of the most recent Commitment of Traders report dated February 18, 2026. 340 million ounces. That is nearly 4 times the entire COMEX registered inventory. They are short on paper. Meanwhile, entities in China, India, the United Arab Emirates, and Russia have been systematically importing physical silver at a pace that accelerated dramatically in the second half of 2025. India's silver imports in 2025 hit a record 4,172 metric tons, up 66% from 2024. The UAE, which functions as a transshipment hub for physical precious metals, saw silver import volumes increase by 43% year over year. Eastern central banks, sovereign wealth funds, and state-affiliated industrial buyers are loading up on physical silver at the exact same time Western financial institutions are accumulating paper short positions. One side is playing a video game, the other side is taking home the prize. American institutions are writing unlimited paper IOUs for silver they do not have. Meanwhile, China, India, and the Gulf states are quietly taking delivery of every physical ounce they can find. This is not new. This has been the pattern for as long as I can remember, but it has never been this extreme. Let me show you the technical indicators because they confirm everything the physical data is telling us. The COMEX silver open interest stands at approximately 218,000 contracts as of last Tuesday, representing over 1.09 billion paper ounces of silver exposure. Against a registered physical inventory of 88 million ounces, that is a leverage ratio of more than 12 to 1. In other words, for every ounce of silver that exists in a COMEX vault available for delivery, there are 12.4 paper claims on that ounce. The historical average leverage ratio is between 8 and 10 to 1. We are now well above that historical range and moving higher. Here's what you need to understand about what that number means. Every time a large commercial buyer decides to stand for delivery on their futures contract instead of rolling it forward, that 88 million ounce buffer shrinks. And as it shrinks, the remaining leverage ratio climbs. And as the leverage ratio climbs, the incentive for the next buyer to stand for delivery increases. This is a feedback loop. It has a beginning, it does not necessarily have a gentle ending. The silver ETP, exchange traded product, flow data from iShares Silver Trust, which trades as SLV, shows net inflows of over 47 million ounces in the first 56 days of 2026. That is approximately 840,000 ounces of new silver demand per trading day being absorbed through just one vehicle. SLV's custodian is JP Morgan. JP Morgan is also one of the largest commercial short holders in the COMEX futures market. Let that sit with you for a moment. The same institution that holds the physical silver backing SLV is simultaneously short silver on the futures exchange. Does that make sense to you? Let me connect all of this together for you. What we are witnessing is a structural disconnect between the paper price and the physical reality of silver availability that has been building for years and is now reaching a point where the two cannot coexist much longer. The paper market has been able to suppress the price discovery signal for a long time by flooding the futures markets with short contracts every time price threatened to break out. But the physical market operates on different rules. You cannot short a solar panel. You cannot deliver a futures contract to a semiconductor fabricator. Real industrial demand requires real physical metal on real delivery timelines. And right now, real physical metal is leaving vaults, leaving mints, leaving exchange warehouses, and flowing eastward into countries and institutions that have no intention of ever lending it back into the Western financial system. The COMEX vault at 88 million registered ounces is not a floor. It is a current reading on a meter that is still moving down. I believe we are approaching the point where that drain forces a response from the market that the paper short holders are not positioned for. Now let me tell you what this means for you. I'm going to be very direct here, no sugarcoating. If you are currently holding physical silver, coins, bars, rounds, held outside the banking system in your own possession or in an allocated private vault, you are in the strongest possible position. The data does not suggest selling. The data suggests that every day you hold physical silver, the number of paper claims competing for each ounce you hold increases. Your position is not weakening. It is strengthening structurally even when the paper price has temporary pullbacks. Do not let a $3 or $4 intraday move in the futures market shake you out of a position that the physical data supports. If you are holding silver through an ETP or a futures contract or an unallocated account at a bank, meaning you own paper silver, a claim on silver rather than silver itself, you need to understand what you actually own. You own a promise. You own the right to request delivery or cash settlement. You do not own the metal. The risk in that position is not the same as holding physical metal. That does not mean you need to panic and sell today, but it does mean you should be asking your custodian very specific questions about allocated versus unallocated storage, about audit rights, about delivery timelines if you were to request physical conversion. Ask those questions now, before everyone else is asking them at the same time. If you are looking to buy silver for the first time, or to add to an existing position, here is the honest picture. At $91 spot, with premiums running at 18 to 23%, the all-in cost of a physical silver round is somewhere between $107 and $112 per ounce at most dealers today. That premium is high by historical standards, but here's what you need to understand. That premium is itself the signal. The premium is the physical market telling you what it thinks the paper price is worth. The premium is the physical market pricing in risk that the paper market refuses to acknowledge. Paying a 20% premium on a real, tangible, deliverable ounce of silver is not irrational when the alternative is a paper claim on metal that may or may not exist in sufficient quantity to satisfy all claims simultaneously. Some people will say this is conspiracy theory. Some people will say I am fear-mongering. Some people will say the COMEX has always functioned and always will. To those people, I say look at the evidence. COMEX registered silver at 88 million ounces, down 34.5% in 12 months. Perth Mint delivering in 6 to 9 weeks. LBMA lease rates at 4.7%, the highest since March 2020. SHFE inventories down 19.3% in a single week. Johnson Matthey reporting a 182 million ounce physical deficit for 2025, the fourth consecutive annual deficit. U.S. Mint Eagle sales up 61.2% year over year with allocation protocols in place. India silver imports up 66% to a record 4,172 metric tons. COMEX leverage ratio above 12 to 1 against registered inventory. Commercial short positions exceeding 340 million paper ounces against 88 million physical ounces available. That is not conspiracy. That is data. That is facts. That is reality. Let me show you the bigger picture, because what is happening today did not start today. Go back 5 years. In early 2021, during what was called the Reddit silver squeeze, COMEX registered inventory was approximately 150 million ounces. The squeeze failed, or was stopped, and prices pulled back. But the inventory never fully recovered. By the end of 2022, it was at 130 million. By the end of 2023, it was at 118 million. By the end of 2024, it was at 102 million. And today, it is at 88 million. Every year, that number goes lower. This is not a short-term fluctuation. This is not noise. This is a 5-year structural drain. Think of it like a reservoir. Every year for 5 years, more water has been taken out of the reservoir than has been put back in. The water level has dropped every single year, without exception. At some point, and nobody can tell you the exact date, the water level drops to the point where the intake pipes are exposed, and the system can no longer function as designed. We are not at that point yet, but we can see the water line getting closer to the intake pipes. This is not a short-term issue. This is not a technical pattern on a chart. This is a structural problem in the global silver supply chain that has been building for 5 years and is now accelerating. Now let me tell you what I believe happens next. I believe the COMEX registered silver inventory continues to decline over the next 90 to 180 days. The forces driving that decline, industrial demand, Eastern physical accumulation, ETP inflows, and declining mine supply, are not temporary. None of them are going to reverse in the next quarter. I believe the silver price tests $95 to $98 in the near term as the paper short holders face increasing pressure to either deliver metal they do not have or buy back their short positions at a loss. The historical parallel I would point to is the palladium market between 2017 and 2020. In 2017, palladium was trading around $900 per ounce with a similar structural deficit dynamic: rising industrial demand, declining mine supply, heavy paper short positioning. By 2020, palladium was trading above $2,700. The move took 3 years, and it was driven not by speculation, but by the slow, grinding reality that there was simply not enough physical palladium to satisfy both industrial demand and investment demand simultaneously. I am not saying silver will triple in 3 years, but the fundamental dynamic is the same: rising structural demand, declining above-ground supply, misaligned paper market positioning. The question is not if the paper and physical markets converge. The question is when. And the lease rates, the premium data, the vault drawdown, and the geographic flow of physical metal all suggest that the when is getting closer. Now, there are 3 types of people watching this video right now. The first type is scared. They see $91 silver and they think they missed it, and they are trying to figure out whether to buy at these levels or wait for a pullback that the physical data suggests may not come in any meaningful way. The second type is confused. They hear about paper markets and physical markets and leverage ratios and lease rates, and they are not sure what to believe or who to trust. The third type already understands. They have been watching the vault data, reading the mint notices, tracking the Eastern import figures, and they are using the paper market's temporary price signals as cover to continue accumulating physical metal at prices the physical market itself says are understated. Which type are you? That is not a rhetorical question. That is the most important question you can answer right now, because the answer determines your next action. The paper price of silver rose to $91 this week. During that same week, COMEX registered inventories hit a multi-year low of 88 million ounces. Perth Mint extended delivery timelines to 6 to 9 weeks. LBMA silver lease rates hit 4.7%. Shanghai exchange inventories fell nearly 20% in 5 days. U.S. Mint Eagle sales were running 61% ahead of last year's pace, and commercial paper short positions stood at more than 340 million ounces against 88 million ounces of registered physical inventory. One of these things, the paper price or the physical reality, is telling you the truth, and it is not the paper price. This is what a structural divergence between paper and physical markets looks like. This is what it looks like when the mechanism that has kept the paper price below the physical clearing price for years starts to lose its grip. This is what manipulation looks like in the data, not in the rhetoric, not in the conspiracy theories, but in the lease rates, in the vault numbers, in the mint notices, in the import statistics. And you get to decide which side of that information you want to be on. If this analysis gave you something the mainstream financial press did not, hit subscribe and turn on notifications. Every time something significant moves in the physical silver market, vault data, mint notices, lease rates, Eastern flow data, you will hear about it here before you hear about it anywhere else. And drop a comment below. Do you think COMEX registered silver holds above 80 million ounces by the end of Q2 2026? Or do we break that floor? I want to know what the people watching this video think, because frankly, your collective intelligence on this topic is more valuable than most of what passes for silver analysis on financial television. The paper price of silver says $91. The physical market says you will wait 6 to 9 weeks and pay $110 when you get there. That is not a market. That is a magic trick. And now you know how the trick works.